are back on Morning Movers. Tesla trading modestly higher this morning after the company proposed a new pay package for Elon Musk. The proposed package would give Musk increased voting power at Tesla and offers new stock options for company milestones, including new product rollouts and adjusted EBITDA targets. Tesla stock is up more than 50% in the last 12 months, but is down more than 15% in 2025. Time now for Options Corner for a closer look at Tesla, the chart. Let's welcome in Tom White, senior options contributor, and the other half of Fast Market. All right, Tom, let's talk about this chart. It has been a difficult year, especially with it in the Mag 7 for Tesla, but it's, starting to try to change the caboose, if you will, or turn the caboose around. What stands out to you when you look at this chart?
Well, the first chart we're going to look at, Diane, is a longer-term chart. Remember back in 2018 when, the board came out with all these projections for Elon Musk, and a lot of people were skeptical there. So that might be, parlaying into what we're seeing out of the board today and these massive projections for the next, major pay package alert here. So if you go back to 2018, this is the levels that we were at, in the mid-teens as far as stock price when they came out with all these projections about ramping up EV production, right? This is going to be the next wave. And they were proven right. If you look over the past, basically 9 years here, even though we pulled back from those all-time highs of about 488 in December, we're still sitting this morning right around $345. So I think anybody that invested, back in 2018, still pretty happy, even though we're not at all-time highs. So this is a longer-term chart. I got another one to look at. It's a 1 year, 1 day, and it's going to kind of reflect what we've seen since those December highs. We're still basically nearly 30% off of those highs, even if the stock opens up at 345. But you can see here, we've seen some consolidation over the last couple of months, right? Elon Musk out of the political picture. It's starting to, consolidate here. You've got 50 and 200-day moving averages, which are continuing to consolidate. And this is one of those names that trades really choppy, right? It's a bifurcating type of name. You either love it or you hate it. So some consolidation may be warranted here because Elon Musk is going back to his companies to try to right the ship here. So that might be a positive. But you look at some of the volume nodes here. Up about $420. That's an area that we've got a big node of volume here. That might be an area that a lot of investors are looking for in a long-term type of scenario. But you've got a good base here around where we closed yesterday, around the $338, $340 level. That's been a big, giant node of a basing here. Now, does this action that we're seeing today make a breakout here? We've had some resistance about $350 over the last couple of months there. Do we get to that level? Is this going to continue to show that Tesla's breaking out to the upside? So that's a couple of the things that you have to look at moving forward as far as the charts go.
Okay, so that's the chart. I'm glad you brought up a longer-term chart because you make a great point that if someone invested back in 2018, they're not mad. Maybe, obviously, we're not at the same levels that they've seen before, same return they saw before. But, okay, so where do we go from here? How would you set up an example trade?
Well, one of the key things in that consolidation phase that we had ahead of this news today is that implied volatility levels have really deflated, right? The IV percentile rank in Tesla is in the low single digits, about 3%. So it's in the bottom, 97th percentile of what we've seen over the last 52 weeks of volatility. And remember, from that chart, it's been a choppy trade over the last 12 months. So you have to take that into consideration. But implied volatility level is really low. So if you believe that, hey, maybe this stock is going to rebound, it's going to break that 350 level and continue to move higher, I've got a strategy that takes advantage of that low volatility environment while looking at a bullish trade here. Went out to the October 17th monthly cycle. So you got 42 days to expiration. You got a month and a half in this position. You avoid earnings, which comes the following week. That's key. And that shareholder meeting at the beginning of November also. So you avoid those events, right? But still taking advantage of a move higher into those events, which sometimes happens in stocks. So going out to that October monthly cycle, we're going to buy the at the money 345 strike call. It's got the higher delta, reacts more like the stock. But then against it, I want to offset some of the costs on that call purchase. I'll sell the 375 strike call. So basically, a bullish $30 wide call vertical to the upside here. You're going to pay roughly, if we open up about 345, about $11 debit. There's your risk, $1,100 per spread. That can expand. That $11 can expand to $30 if we hit that 375 level. Now, if you pay $11 debit, takes your break even up to 356. That's going to be about 3% above where the stock's going to open up here today. So you don't need a monster move to the upside here. It tops out above 375 as far as profitability. And remember that IV percentile rank low, so you're buying this vertical for a directionally bullish trade at a low entry point. But you do have some risk, $1,100. You do need that move to the upside here if we get that breakout. And one of the key things with a trade like this, Diane, is you've got some flexibility as far as trade management goes. You don't have to wait until expiration over the next 42 days. If you get the move that you want ahead of time, you can close this position early or maybe close a portion of it, of the position early. But it's definitely a bullish trade where you need a move to the upside.
Okay, so you need to move to the upside, bullish call vertical there. That's the example trade there for Tesla. Thank you, Tom.